a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about small cap ETFs. Now, small cap stocks have been outperforming their larger cap counterparts this year, in fact, for the past few months. And that's mainly because many investors believe and hope that we are nearing the end of the Fed's rate hiking cycle. And once the Fed stops raising rate, probably we will see a bottoming of economic growth, and economic growth is going to rebound. And once the economic growth picks up, that benefits smaller companies more than larger companies, because these are domestically oriented companies, and also because investors are looking for cheaper valuations now. So these companies are more attractively priced. And also we have seen a shift in consumer spending from goods towards services. And smaller cap companies are more in the services sector. So that is another reason why these companies have benefited. Now, there's a lot of interest in small cap ETFs, but there are significant differences among popular small cap ETFs. So let's take a look at those ETFs so that investors know what they are investing in. So let's take a look at 3 small cap ETFs. So the first one we are taking a look at is the most popular, largest small cap ETF. The ticker symbol is IJR. And as the name suggests, it tracks the S&P Small Cap 600 index. Now, this index is not as popular as the Russell 2000 index, but this is the most popular ETF in this space, and it has seen very large inflows lately. So since it tracks the small cap 600 index, it holds about 600 stocks. As I mentioned, the largest in this space with 73 billion in assets, ultra cheap with just 6 basis points expense ratio. So to learn more, you can go to the quote page on Zacks.com. You can read our research report articles, and using the link, you can go to iShares webpage for this ETF. Now, as I mentioned, small caps are much more attractive. So this has a PE of about 13.3 compared to S&P 500's PE of close to 20. Now you should look at the holdings too, so you may not recognize the companies much. These are all small companies, but let's take a look at the sector breakdown. Industrials and financials both close to about 18% each, and then consumer discretionary and information technology. The second ETF that we are talking about tracks the very popular Russell 2000 index. So whenever you hear about small cap companies, normally in financial media, normally analysts refer to Russell 2000 index. So this tracks the Russell 2000 index, and is the most popular ETF tracking the Russell 2000 index, and it holds close to 2000 stocks. So you will get much more diversification in the portfolio. This is also very popular with 57 billion in assets, but slightly pricey with 19 basis points. It's still reasonable, but compared to the earlier one. Again, you can look at, read our articles, and let's take a look at the portfolio, what this ETF holds. So looking at the exposure breakdown, you will notice the differences. Financials, then healthcare, and then industrials and information technology. So those are the differences between the two ETFs. Now the third ETF which I'm highlighting is slightly different, but it has done quite well over the past year and also this year, and it has beaten both small cap growth and small cap value ETFs. So this tracks the S&P small cap 600 pure value index. So basically the companies with strongest value characteristics within the 600 S&P small cap 600 index. This you will get a much more concentrated portfolio with 152 stocks, much smaller compared to those two giants, and slightly pricier too, 35 basis points expense ratio. Let's take a look at this ETF. So basically, it uses the following factors: book value to price, earnings to price, and sales to price to determine the companies within that index with strongest, purest value characteristics. Olympic Steel, MI Homes, Genworth Financials, these are among the top holdings in the portfolio. Looking at the sector exposure, you will get a lot of exposure to consumer discretionary names, 27%, and then industrials, 17%, and financials. So very different kind of sector exposure. So as long as consumer remains strong and consumer discretionary stocks do well, this ETF may do well. So on the next slide, I have the comparative performance of the three ETFs that we discussed versus the S&P 500 index. And you will see that the pure value ETF is up about 11%, significantly outperforming all other ETFs. The iShares IJR ETF is almost flat, and the other ETF, which tracks the Russell 2000 index, is down about 2%, and the S&P 500 index is down about 6% during this period. Thanks for watching. Make sure to check out zacks.com/promo for an interesting offer. Also, make sure to subscribe to our videos so that you do not miss anything. I will see you next week.